please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We have some guests joining us now.
Yes, it's a big day, so we have many guests.
Yes, Geoff Dennis of UBS and Bob Dole of Nuveen AMC, and of course Arvind Sanger of Geosphere Capital. Thank you. Good evening to all of you, gentlemen. Thanks a lot. What a rough day for equities. Jeffrey, let me start with you. Your thoughts on this brutal sell-off that we have seen over the last 2 or 3 days?
Well, clearly, as far as we're concerned, the whole thing began with the disappointing or the strength of wages, earnings in the Friday payroll report, and that led to a further sell-off in bonds, and that gave you a bad Friday. And I think just basically the selling continued on the back of that. There was a lot of program selling, a lot of just to a certain extent capitulation, I think, driven initially, as I say, by an inflation scare which came through with the payroll numbers on Friday. Now, what has been the big factor here, which I think could indeed have caused contributed to the scale of the rout, as well as obviously being part of it, is how much the VIX, the volatility index, it went up a record amount today, over 100%, more than doubled. One good sign, I think, is that bond yields did rally, did fall back. There was some buying of bonds, I think, a sense of flying to quality to a certain extent. But we put it all down initially to Friday and the fallout from that, relatively high earnings number.
Yeah, actually, Geoff, that was the point even I was wanting to raise with all of you guys. We thought we should keep looking at the US bond yield, and when it seems to have peaked off the yield, then probably the market mayhem will stop. But yesterday we saw a steep fall in bond yields as well. In spite of it, the market had its worst fall. Bob Dole, if you can explain that to us. The markets fell when the yields rose. The markets fell when the yields fell.
Yes, we have to put this in perspective. The stock market's just where it was 6 weeks ago. Yes. A lot of people are acting like this is the end of the world. It's not even close. The U.S. economy is doing reasonably well. And look, the 40 basis point rise in the 10-year Treasury from January 1st is just too fast for the equity market to handle it. Yes, you're absolutely right. Yields have come back to some degree, but the reaction to it is still going on in equities. And as you just heard, there's been some forced selling. There's some program trading. There's some panic. There's some capitulation. And so it should be no surprise that we continue to give back some of it. Yes, this is the biggest point decline, but nowhere near the biggest percentage decline. This is because we haven't had this kind of reaction in markets for quite some time. People are pretty excited about it, and I'm not trying to minimize it in any way, but we'll find a bottom, and if we go higher, it's because the economy is doing okay. That will be the earnings story will be the story if it stays good.
Okay, when we'll come back to take that point forward, Bob, we also have Arvind Sanger on our panel. Arvind, hi, good morning from India. Global sell-offs in the recent past have been the best buying opportunity for Indian investors, at least. We saw it with the case of the Brexit as well. Do you think this time could be the same?
Well, this time is a little more complicated because India has its own problems. India itself is going to have an inflation issue, and the RBI is probably going to be, much more hawkish than it's been in the past. So you have that. And I think you have the, capital gains, which is unfortunate timing. And you have, bureaucrats talking as if markets only go up, so investors make easy money. And those are, unfortunately, contrarian indicators in terms of complacency on the part of, the government in terms of thinking that markets are a one-way street. And that's, those are all negative factors that are slightly more, more deeper in concern. But I think that, with the growth and everything else, hopefully getting back on track, even with a budget that's a little bit, less, I guess, disciplined than we would have hoped. Hopefully the market sell-off in India will wind down, but I would say this is not all about foreign selling and India just feeling the brunt of global factors or India factors.
Okay, so Arvind, are you saying that India could actually underperform? And actually we did that even in the month of January when the MSCI Emerging Market Index went up 10% and we were up only about 4 to 5% thereabout.
Well, it could, but I think one of the good news in the last few days for the Indian market has been that oil has come off. So to the extent that that was one of the negatives, that's lessened. But I think, India had a great year last year. It was one of the outperformers. So the fact that it's giving back a little bit of that outperformance doesn't necessarily make it cheap by itself. I think what will matter now is how the various cross currents play out. How does the RBI policy create any challenges for the economy? How does the growth that we've been all expecting after GST issues get digested deliver? And this quarter was somewhat encouraging. And how does the government remain supportive versus assuming that the stock market investors are cash cows to fund, populist policies for the next election? I think those are all factors that will interplay, and I don't think that 2018 is going to be as simple and easy a year as 2017 was for Indian investors.
Yes, we're already talking about it as the good old days now, 2017, isn't it? But Geoff, as a global investor, what do you do? Are you sitting out and just waiting for it to find a bottom? Are you buying? What is the pecking order of equity markets that you will choose?
Well, we haven't changed our view, frankly, and we are constructive about emerging markets, which, of course, is what I cover for the medium to long term. I think it's just a question of trying to find out, how much further this sell-off could go. Our sense tonight is that the VIX increase, the volatility increase, may well already be at its peak, but we're not sure yet whether there may be more selling in terms of the S&P in the short term. Now, this is all getting driven, in our opinion, only by the U.S. market, but what Bob said earlier is absolutely correct. The global economy looks good. The U.S. economy looks good. Earnings look good. And frankly, what has really helped emerging markets to hold up relatively well in the face of this big sell-off of the U.S. Is that the dollar has not rallied to any great extent, and that's minimized. There's been some currency selling in the end, but it's minimized that. So, I think you just have to wait and see. This thing is going to blow itself out. It's not going to lead to a dramatic, rout of a large amount from here. And at that point, I think you have to take another look at emerging markets again. And we like places like Brazil, we like Russia, we like Korea. As you know from a previous interview I did with you a few days ago, we're a bit more cautious on India now. But I think we just have to see where the bottom is in the U.S. And frankly, it may not be that far away.
Okay, so that brings us back to the question about what the U.S. market could do from here. Bob, this U.S. market tumble throws the Fed rate hike schedule into question, because we all know that the government, including your president, is very cognizant of, the kind of impact that all of this has on the stock markets. Would you change your view on how many times the Fed could hike its rates through the course of the year?
On the assumption that this is a good old-fashioned correction and has not a lot farther to go in terms of price, I would not make any changes at all. We do need, as everybody's mentioned, to keep a careful eye on inflation. The wage number was troublesome, and that calls into question how many rate increases the Fed might go. Now, we also know that monthly number is a very volatile series, so we'll see how that shakes out. But I would not change my view on the Fed going 3 times this year.
Okay, not 3 times this year. That will be interesting. Arvind, so for, back home, the big question that a lot of portfolio investors are asking is what next? And this market has been driven by retail flows, but, a lot of that money has not seen any correction. So this would be the first genuine correction. So what should be the portfolio approach from domestic investors' point of view who have put so much money in the market over the last 2 years?
Well, I think, to the point that somebody else made about the U.S. market, that all we are seeing is a correction that people are panicking like it's the end of the economic cycle. I think the same thing applies to India. The economic cycle or the growth cycle, notwithstanding whatever RBI does, is still intact. But I think one of the things that portfolio investors need to keep in mind is that at the end of the day, in calculating the PE multiple for the market, the interest rates are in the denominator. And if interest rates are going up, to the extent that you discount the earnings, then whether it's the U.S. market or it's the Indian market, the PEs may have benefited from low real rates, and those PEs might moderate a little bit. And I think, therefore, it's a fine line between, is the growth coming back, and what does the interest rate environment suggest, the earnings multiple that we can pay for that. I would say, that's a long-winded way of answering that. I think portfolio investors should be opportunistically stepping up into companies that they like. You can never pick the bottom. The bottom we only know looking in the rearview mirror. But I think there are a lot of good companies that are going through a severe correction. And if people are disciplined about long-term value, then there will be good opportunities here over the coming days. And I don't think we're that far from in terms of number of days of sell-off, in terms of us, finding some kind of stability. But there's no point rushing in and putting all the money on the table, too quickly.
That's cautious optimism. Gentlemen, thank you very much for joining us. Arvind, just one final question to you. Which stocks are you looking at in this fall? Would it be IT stocks in India? Would it be, economy-facing stocks like, say, a Larsen?
I think it is some of the economy-facing stocks. I think it can be companies with, maybe more rural exposure, which clearly the government is going to be doing more spending in.
Okay.
I think it'll be infra. I think the area that has been a big winner in the last year, which is financial-related stocks, could be somewhat less out of favor. NBFCs have been an easy win in the last 12, 18 months, and those could be somewhat less attractive as compared to some of the real economy beneficiaries.
All right. Thank you very much indeed for joining us. Yes, NBFCs, they're a stock that probably some of their money is also in capital markets.